Alright guys, welcome. This is Rally Top Investing. This is our free mentorship program. In this program, we are going to be looking at 3 topics, which are market structure, imbalance, and the other blocks. Now, before we go into our teaching, let me first off give you a framework of what you should expect in this program. Now, it is a 5-day program, as you may have known. The first 3 days of the 5 days will be theoretical, meaning that on each topic we are going to be releasing a video. So we are going to have 3 videos for 3 different days, and the last 2 days of the program will be for question and answer. Okay, and we are hoping that during the question and answer we shall use a Zoom meeting to do that. But the Zoom meeting is going to last only for 30 minutes each day for the 2 days I'm talking about. It's going to last for only 30 minutes, so take note of that. In that light, you will need to send all your questions beforehand. Send your questions beforehand that borders on the 3 topics we are going to treat in this program. So you send your questions beforehand so that the remaining 2 days of the 5-day program, we use that to answer your questions. You can be sure that I will attend to your questions very effectively. But in the case that we are not able to answer all the questions within the 2 days that we have, the 30 minutes Zoom meeting that we'll be having for the 2 separate days, be sure that I will still answer your questions even after the program. Alright? So that is what you should expect. Now, we are going to be starting with market structure. Now, as you know, market structure is the foundation of forex trading. Without a proper understanding of market structure, there is no way that you can become successful trading the forex market. The smart money, the big institutions, watch some levels, and you need to understand those levels yourself as a trader, right? Now, in today's topic, market structure, we are going to be dealing with 4 concepts, and it will do well for you to listen to this teaching of today, because it's the foundation of your trading. The number 1 concept we want to look under market structure is how to determine directional bias of the market. Number 2, we want to look at break of structure. We have 3 types of break of structure, and we want to tell you the one that we use at Rally Top. Number 3, we want to consider the higher time frame swing points and the lower time frame structures. Very, very important. And finally, we want to look at the external and internal range liquidity. Alright? These are concepts that will help you to build up your trading skills in terms of market structure. So pay attention very, very carefully. Alright? Pay attention very, very carefully. Alright? Now, you know that in the market, how often do you see price do something like this? How often do you see that, guys? How often do you see price move in a straight line like this? Not so often, right? Not so often. So price does not move in a straight line the way that many traders think. Neither does price move in a clean manner such as this. Take a look. How often do you see price move in this clean manner? Not so often, right? That's it. Price doesn't move in that clean manner. The reality of the market is that price moves in a wave-like pattern. It moves in a zigzag pattern. And you need to understand, what are you looking for in a trend? How do you determine a trend in this zigzag movement of price on the chart? If you do not understand how to look for trend, how to determine your directional bias in this zigzag movement of the price, you get lost. All right? Here lies the problem of so many traders all over the world. All right? Now, as you can see, this is the reality of the market. This is the way the market actually moves. This is the way it moves. Now, when price is moving this way on your chart, very many traders will think, look at this portion for instance. Many traders will think that price has broken structure here. Look at it. Many traders will think because price has broken structure here. Just a minute. Many traders will think that because price has broken structure here to the downside. Can you see that structure break? Many will think that that is a break of structure to the downside. So they will assume price is now coming down. No, price is not coming down. Now, a lot of people too will look at this condition here, that price has broken structure to the upside. Take a look at it. That price has broken this structure to the upside. All right? They will think price has broken this structure to the upside, and they will think that is a break of structure. This is where a lot of traders go wrong. That is not, yes, actually it's a break of structure, but that break of structure is immaterial. It is not important. It's insignificant. Why? Because it is yet to break the major swing point here. All right? Price came from below here, from down here, and printed a high and then pulled back. That high is where your focus should be. That high is where you should pay attention to. That high and this low here is where you should pay attention to. In our previous video on Market Structure Simplified, I made it clear that your duty as a trader when determining your structure is to focus on the swing high and the swing lows. I said in that video that you mark out your swing high and your swing lows with horizontal lines and wait to see what price action will do around those horizontal lines, these swing highs and swing lows. All right? So all this that happened here is what is known as noise in the market. All right? It is noise. It has no bearing to what happens to the swing high and the swing low here. All right? Now, price did all its what can you call this? It did all this confusion here, this complex pullback. It is known as complex pullback. Complex pullback is any pullback in between the swing high, a major swing high and a swing low. Anything that happens in between a major swing high and swing low is known as complex pullback. I want you to understand that. Now, price eventually broke out and closed above this swing high here to form a higher high. Can you see that, guys? Now, this is our higher high. Why is it called a higher high? It is called a higher high because it's higher than this previous high here. All right? Now, when you have that higher high, where is your higher low? Your higher low is this one. It's this one. This is your higher low. This is not your higher low. even though this has broken structure here, but this is not your higher low. Why is it not your higher low? Because it didn't have the strength to push price up to break this major structure high here. Can you see that? So this is not your higher low. This is not your higher low. None of this is your higher low. Your higher low is this, because this is the leg that has the strength, the power to break the swing high here. Please, I want you to understand. Now, how do you determine your directional bias? For you to determine a new trend, it is a rule-based system. Here at Rally Top, we trade rule-based system. For you to determine a market direction, you need double break of structure. I cannot emphasize this enough. You need double break of structure. Why do you need double break of structure? It is because if you are taking trades based on a single, this first, for instance, this break of structure here is a single break of structure. All right, can you see my cursor? Now, if you based your determination of trend on this one break of structure here, possibility is this, that price will break that structure and it was just a liquidity grab, only for price to push down. All right, only for price, all right, to push down. Sorry guys. All right, only for price to push down like this and continue with a downtrend, breaking this structure, all right, breaking this structure, and then continue on in a downtrend. All right, so that is why you need to wait for a double break of structure. All right, so the way we determine a trend at Rally Top, the way I personally determine a trend, is to wait for a double break of structure, and this replicates on all time frames because price is fractal. So you need to see a double break of structure on any time frame that you want to trade for you to know there is a new trend in place. All right, that is the rule-based method of knowing whether you are in an uptrend or in a downtrend. You need a double break of structure. That is, you need to wait for price to break a major swing high such as this and make an impulsive move up that creates a higher high. You need to wait for price to retrace and then make another impulsive move up to break the swing high of the first impulsive move. That is when you will know price is now ready to move higher. All right, the same thing with the downtrend. You need to see a double break of structure before you can determine the direction of the market. All right, just like I explained during the example of the bullish trend, the downtrend is exactly the same way. It's exactly the same way that price has broken structure here to the upside. Does not in any way confirm that price is now going bullish. It does not in any way confirm that price is going bullish. All right, so what you want to see is for this major swing low here to be taken. Once that major swing low is taken, you mark out that your low that has been broken with an horizontal line, and then your high. This is your high. Look at my cursor. This is your high. It is none of this. This is not your high. This is not your high. It's not your lower high. This is not your lower high. This is your lower high. Why? Because this is the leg that has the strength to push price to break structure here. All right, the sellers couldn't gather strength. They couldn't muster much strength to push price from here to break structure. The sellers tried, but the buyers took over again and pushed price up. And then the sellers now here mustered enough strength to now push price to break major structural low here. Can you see that, guys? So in determining your directional bias, you need this double break of structure. I cannot emphasize that enough. Enough of directional bias. Now, the next point we are looking at is break of structure. Break of structure. Let's look at some diagram concerning the break of structure. Now, take a look at this. We have three types of break of structure. All right, three types of break of structure. This is contained in our PDF file. If you go to our Telegram group, you will find it on our Telegram group. We have a free PDF file that you can go through. Now, we have three types of break of structure. This is type 1. Type 1. As you can see, price dropped down, all right, and formed this low, and then price rallied up. It rallied up to this point, can you see? And then retraced, leaving this wick, this candle wick here. Now this candle wick has broken this candle wick here, meaning that the first type of break of structure is a candle wick breaking a candle wick. Can you see that, guys? A candle wick breaking a candle wick. But at Rally Top, we do not consider this as a break of structure. Some other people consider it as a break of structure, but we at Rally Top don't consider it as a break of structure. All right? So type 2. This is type 2. Price rallied down and printed this low here, and then price rallied up and closed above this candle here, the candle body here. A candle body, this candle body closed above this candle body. So candle body breaking a candle body is the second type of break of structure. Again, at Rally Top, we do not consider this as a break of structure. All right? Now, this is the third type of break of structure. Price rallied down. This example is for bearish move. Now, the same thing with bullish move. It's just it's an introvert. I mean, you turn, if you turn it upside down, it is the same thing for the bullish trend. All right? Now, here, price pushed down and printed a low here, and then price pushed back up and closed above this candle wick here, this high. It closed above this candle wick, which is the high before this drop. All right? So this is candle body closing above a candle wick. Candle body closing above a candle wick. This is the third type of break of structure. This is the break of structure. This is the type that we consider at Rally Top as a valid break of structure. You understand that, guys? This is our valid break of structure. None of this. But it depends on your personality and your backtesting. If you backtest with any of these and it resonates well with you, why not? You can use them. You can use any of these as your break of structure. But for me personally, this is my valid break of structure based on my backtesting. All right? So that is about break of structure. The next point that we want to consider, as you can see here, our next point is higher time frame swing points and lower time frame structures. All right? That is going to be a very important one, important concept for you to pay attention to. Take a look. Now, this black line, as you can see here, this black line is swing point. It's a higher time frame swing point. This black line, can you see? Now, this red line is the lower time frame or intraday structure. You can call this black line a major structure, and this red line minor structure. All right, very important. Now, what is higher time frame swing point? Now, I expect you as a trader to understand that for you to map out your structure, for you to determine your directional bias or map out your structure, you need to make use of the higher time frame. Now, a lot of traders are trapped when they start from lower time frame like 15M. All right, they start from 15M or 5M, and they say they are scalpers, so they start from 15M. If you are that type of trader, then you will be facing a lot of troubles. You'll be stopped out several times in the market because you do not understand what is going on in the bigger picture. You need to know your bigger picture. What is the higher time frame saying? Your higher time frame trumps every other time frame below it. Your higher time frame is key for your mapping of structure. All right, you need to mark out your higher time frame swing point. Right, when we talk about higher time frame swing point, take a look. Let us assume that this black line is the 4-hour time frame, and this red line is the M15 time frame. All right, now on the 4-hour time frame, this black line price pushed up and printed a high here. That is a major swing point. It's a major swing high. It printed a high here and then dropped, retraced to print a low, a major swing low, and went up again to break this previous major swing high to form a new higher high. That is a major swing point. This is a higher time frame swing point, and then it pulled back to form this swing low here. This is a higher time frame swing low. I want you to understand this. It pushed up again to break this previous swing point here. All right, and created a new swing point, which is a new higher high, higher time frame higher high, and then pull back to form this higher low. This is a major swing low, and then price push up again to break the previous swing point to form a new higher high. Can you see that? We are still talking about these black lines. These are your major higher time frame swing points, right? These are your higher time frame swing point. It is crucial, it is important for you to mark out your higher time frame swing point, the swing high and the swing low on your higher time frame. You can use it depending on the type of trader you are. Now, for me personally, my higher time frame that determines my directional bias is the weekly, daily, and the H4. These are the three higher time frames that help me to determine my directional bias. Yours could be daily, H4, and H1. All right, it could be, but whatever the case, you have to understand what goes on the higher time frame, because what goes on the higher time frame will certainly affect the price action on the lower time frame. I want you to understand that very well. Okay, so mark out your swing point on your higher time frame, and now when you drop down to lower time frame such as M15, I've told you this black line, let's assume it is 4-hour and this red one is 15M. Right, now as you can see on the 15M, price is breaking the high, making higher highs, higher lows, higher high, higher lows, higher high, higher lows, in line with this impulsive leg of the higher time frame. All right, and when it got to the higher time frame swing point, take note of it. When it got to the higher time frame swing point, this is the last lower high on our 15M. Right, this is the last higher low, and before this higher high here, I'm talking about the red lines now, the 15M. Now, price now changed direction on M15 and started making lower lows. It broke structure here, this last significant structure low. It broke it to the downside and start making lower low, lower high, lower low, lower high, lower low. Now, if you did not mark out your higher time frame swing point, if you go straight without looking at the bigger picture, you go straight to 15M, what you will see with this leg here, with this very leg, what you are going to see is price breaking the lows, making lower lows and lower highs, and then you will just suddenly think that price is bearish, and then you enter the market going short. All right? Whereas what your 15M is trying to do is to come down to the major swing point, the higher time frame swing low here, in order to create a higher low for price on H4 to move higher, to break this swing point here, all right, higher. Do you understand that? The price action you see on your 15M here is to help the H4 create a low, a higher low for price to continue higher. Do you understand what I'm saying, guys? So if you did not mark out your higher time frame swing point, and you start by going straight to your maybe M15, M30, M5 to look for your structure and enter your trade, this is what will always happen to you. You will always be stopped out because you do not have any idea about what is going on the higher time frame. Do you understand, guys? This is very crucial. This is where a lot of traders are having problems with their trading career. So I want you to take note of that. Always look at your higher time frame, mark out your higher time frame swing point, so that when you get to your lower time frame, you will not be lost in the noise that will happen there. All right? So that is why am I telling us this? It is because a lot of traders have asked me that when they go to their higher time frame, such as H4 or D1, what they see is perhaps bullish structure. But by the time they go back, they go to their lower time frame, they find bearish structure. So they ask, which of them should they now take? Are they going to take the H4 bullish structure as the trend, or their 15M, which is the bearish structure, as the trend? This is where the problem lies. You must understand that your lower time frame is reacting to help the higher time frame to move in the higher time frame's direction. I want you to understand that very well. So that is about higher time frame swing points and lower time frame structures. All right? Now, the next topic we want to talk about, the next concept under market structure, is external and internal range liquidity. It is important that you understand your external and internal range liquidity. All right? It will help you tremendously in your trading journey. Now, what is external range liquidity? Now, take a look at this. Here is a swing high, a major swing high. Like I told you, the black line, let's assume, is H4. This is your H4 swing high. All right? And price pull back and push up again to break that major swing high with this red line. All right? Now, when it broke this major swing high, all right, with this horizontal line that you see here, so now this is your low, this is your high, this is your trading range. Your trading range is between this swing low here and this swing high here. Why is it your trading range? It's because price has violated this previous swing high here. So this is now your break of structure. This horizontal line here is your break of structure. So this is your swing high. This is your swing low. This is your trading range, guys. I've made that abundantly clear in our previous videos, so I don't need to go into that in details again. So this is your trading range. All right, now what is your external range liquidity? External range liquidity is liquidity that rests outside of your trading range. I've just explained what a trading range is right now. Now I am saying your external range liquidity is the liquidity that lies above or below and below your external range. I mean, the liquidity that lies above and below, outside of your trading range. I take that again. External range liquidity is the liquidity that resides outside of your trading range. What do I mean? I'm talking about, I've told you your trading range is this high and this low. This is your trading range. All right? Any liquidity that resides above this swing point here is your external range liquidity. Any liquidity resting below this swing low here is external range liquidity. Do you understand that? So that is what we mean by external range liquidity. Some traders have asked me, external range liquidity, internal range liquidity, and I told them, what exactly can your knowledge about external range liquidity and internal range help to improve your trading? And they don't know what to answer because they have just had the terminology from other professionals, other mentors, and then they think by knowing it theoretically will help them in any way. All right? So that is your external range liquidity. Now, what is internal range liquidity? Internal range liquidity is any liquidity that lies in between this your swing low here and your swing high. It is internal range liquidity is the liquidity that is created from the lower time frame that is within your trading range. Do you get it, that guys? I want you to understand that. For example, this 15M structure here, this internal range liquidity are all this liquidity here. They are all this liquidity. You understand? We are not going to talk about liquidity in this course, right? But I just want you to understand that. Now, when we talk about liquidity, anytime we have a course on liquidity, then you will know the various types of liquidity that you need to focus your attention on. And then you need to know your internal range liquidity at that point and your external range liquidity, because it will help you to stay out of trouble in the market. All right? So your internal range liquidity is any liquidity that lies in between your swing low and your swing high. Very, very important. As you know, liquidity lies above every high and liquidity lies below every low, right? So we are not going into the topic of liquidity in this course. All right, guys, enough of that. Let me show you how to determine your structure and how to map out your structure in real time. All right, so let's go to the charts now. Take a look at this, guys. Let's be blind to the price action that happens to our left here. We are going to start somewhere here, all right, and go and move to the right. Let us assume all this at the left did not happen. We don't know anything about it. Here is our starting point. Now, as you can see, price printed this low here. I mean this lower high here. See where you find this cursor. Printed this lower high. Can you see that? And dropped. When it dropped, it broke structure here. Now, let me emphasize this. Let me emphasize this point. You cannot have, anytime you have a lower high, in the case of a downtrend, there must be a lower low. All right? If the lower high does not produce a lower low, if the point you mark as your lower high in the case of a downtrend does not produce a lower low, it is not a lower high. It's not a valid lower high. I want you to understand that. And in the case of an uptrend, if where you mark as your higher low does not produce a higher high, that higher low that you mark cannot be a valid higher low. A higher low must produce a higher high, and a lower high, in the case of a downtrend, must produce a lower low. All right? Now, in this case, here is a lower high, all right, and price dropped to break. Here is a lower high and price dropped to break this structure low here. Can you see that? Remember, our break of structure is a candle body breaking a candle wick. As you can see, this candle body broke this candle wick here. Can you see that? So this is a valid lower low and this is a valid lower high. If you now take your horizontal line, like I said to you earlier, now your focus should be on your lower, on your swing high and your swing low. Remember, this is daily time frame, dollar yen daily time frame. So if you mark out your high with an horizontal line, all right, you mark your high with an horizontal line, all right, you wait to see what price action will do. You mark your high there with an horizontal line and you mark this low with your horizontal line. I told you that in our previous video. Very, very crucial. As a beginner, you need to always do this because it's going to help you to be able to know where you are in space. All right? It will help you to know where you are in space. All right? Now, this is your high. This is your low. Now, price has broken the high. Can you see that? With this impulsive move up, all right, it has broken the high. Can you see that? Now, if price had come down to break this your horizontal line low here to the downside, then it might be time to start looking for sells. You understand? But here, price has violated the high here to the upside. So meaning that price is trying to go bullish. Now, I've told you, let us assume, let's be blind to price action to the left here. But for a moment, let's imagine that price was coming up from up here, down to this place. Meaning that price was bearish and got to this point and then broke the last lower high. All right? We are assuming that price was bearish from here to the left, right? And came to this point and broke this last lower high. And price broke it to the upside. Now, from what we have been saying since, does this break of structure here indicate or confirm that price is now bullish? Not at all. Certainly not. It does not confirm that price is bullish. All right? Why does it not confirm that price is bullish? It is because this could simply be a liquidity grab, and then before you know it, price can just drop down to continue with the previous downtrend. Do you understand what I mean? So that is why we don't consider the first break of structure as a confirmation of a new trend. All right? So price has broken structure there to the upside. This is your swing high. This is your major swing high. And this is your major swing low. Everything that happened in between this your swing high and this your swing low is noise. It's simply noise. All right? This is just what is known as complex pullback. Your concern is not what goes on here. Your concern is this swing high and this swing low. All right? Your concern is to wait to see if price breaks this swing high. Then you now know you can find your order block. Do you understand, guys? None of this is your problem. All right? So price has broken structure once. That does not confirm we are in a new trend. Now it rallied up and created this high here. This is a higher high. Why is it called a higher high? It's called a higher high because this high is higher than this high here. Can you see that now? All right? It's higher than that high there. Can you see that? And where is your new low now? Where is your new low? I'm coming. Let me remove that. All right? So where is your new low? This is your new high. This is your new higher high now, because it has broken this previous high to form a new high. So this is your new, this is a higher high now, your new higher high. So where is your low? You can see that price pulled back here and rallied up to break this structure. Where is the low that had the strength to break the structure? It is this low here. So what you do, like I told you in the video on market structure simplified, what you do is to move this your horizontal line to this your low here. This is your new low. Guys, do you understand what I'm trying to say? This is your new low. All right? This is your new low. And this is your new high. Can you see that? Now, where is your trading range? Your trading range is between this low here and this high here. Can you see that? That is your trading range. This is now your break of structure, because price has broken the structure to the upside. This is now your break of structure. All right? Now, we continue. Now, price now created a new higher high. You move your horizontal line to this new higher high here. Move your horizontal line to the new higher high. Can you see that? Now, where is your higher low? Now, this still remains your higher low. This is fine where it is now. It still remains your higher low. All right? This is your trading range. From here to here is your trading range. So, in terms of taking entries, you look for your OB within this range. All right? We are not treating the OB yet, just yet. We'll get to that. All right? So, now, this is your new higher high, and this is your new higher low. Now, take note, price has broken this structure here. Can you see? Price has broken structure again. I want you to understand. Price has broken structure. I don't know why this thing is moving like this. All right? Price has broken this structure here. Can you see? I told you earlier on that even if your candle body closes with only one pip above a candle wick, it is still a valid break of structure. Take a look at it. This candle broke this structure high here to form a new higher high. So this is our new higher high. Can you see that? Because there is a break of structure here. All right? Now, you move your horizontal line. Once a higher high has been created, you move your horizontal line to that high. That is your new higher high now. Where is your new low? Now, this is the low that had the power, not this one. Not this one, guys. This is the low that had the strength to break this previous high here. So this is your new low. So you move your horizontal line from this to this point. This is your new low. Can you see that, guys? This is your low and this is your high. This is your trading range. All right? In terms of entry, you look for the OB within this your trading range to take trades from. All right? Now, take a look again. What happened? Price broke through this swing high to create a new higher high. So once a new higher high is created, I've told you, move your horizontal line to the new high that has been created. All right? Move your horizontal line to the new high that has been created. And where is the low that produced this high? This is the low that produced the high. So you move your horizontal line to that low that produce the high. So here is your trading range here. From this low to this high is your trading range. All right? Now, but look at this price action. Price now moved down aggressively. It moved down. Look at this one candle. It moved down aggressively and closed below this low. Can you see that? Does that mean we are now in a downtrend because it has closed below this low? No. This is just one break of structure. It closed below this low and then came down still and broke this structure here. Right? This is simply a liquidity grab. Now, if you are the type of person that trades with only one break of structure, seeing this break of structure here, you would have said we are now bearish, and so you will mark this candle as your OB. But look at what price would have done. Would have taken you out of the market, because this is just one break of structure. All right, we need a double break to confirm a new trend. I cannot emphasize that enough. Now, this is simply a liquidity grab. Price grab liquidity that was resting below this low, grab liquidity that was resting below this low too, and price pushed up to break structure high here. Can you see that? So where is your new high? This is your new high, guys. This is your new high. Always remember, this is your new high. Once a high has been created, move your horizontal line to that high. This is your new high. Can you see that? Now, where is your new low? Take a look. This is your new low here. Can you see that? So you move your horizontal line again to that new low. This is your new low here. All right? This is your new low. Can you see that? That is your new low. So your trading range is between here and here. This swing low and this swing high here. So you will need to look for your OB in between this trading range for your entry. We are not going to treat entries in this course. We are only going to look at the concepts of market structure, imbalance, and the other blocks. All right? Okay. So this is your trading range. You look for the OB. As you can see here, this OB here is already price reacted to something here. All right? We are not treating that. So now, this is your new high and this is your new low. Now, if you look, this is a relatively equal high, right? And when you have a relatively equal high, what do you expect? When you have equal high or relatively equal high or equal low, relatively equal low, what do you expect? Well, for me personally, I cannot take trade from here. Because why? I cannot mark any OB here. Why? Because of this liquidity that is resting above here. Be sure that the smart money can push price down a bit for retail traders to think that price was going down. But ultimately, they have an objective to come back up here to clear the liquidity resting above this high. But we are not going into that in this course. All right, guys, that is how far we can go with market structure. I hope you have learned a new thing today. If this was interesting, then you need to stay tuned because we have more valuable content in this course to share with you. All right, guys, we draw the curtain on the class of today. I see you in the next class. Have a wonderful time.